of these kind enough to give take-ins. All right. So, here our general introduction. And yeah, chapter 1, which I keep saying should be easier to look at as we progress, because some of these code sections are really going to start looking familiar. I think some of the biggies, there's not a lot of code sections here, guys, but code section 641 just stands for the proposition that trusts and estates, unless otherwise stated, are taxable like individuals. Code section 643 talks about D&I, right? Everyone needs to know how to compute D&I, and we're going to go through several exercises today. And so the authors are just giving us some introductory code sections, including code section 1E, which has the compressed rate structure for trust and estates. Remember that when trusts earn income, they're essentially taxed at a flat 37% tax rate. All right. So that takes care of some of those code sections, but again, chapter 1, guys, just designed to see it. We all know what an estate is. In certain instances, trusts we know they're either testamentary, or inter vivos. Testamentary means formed at death. Inter vivos means that they are formed during life. Some trusts are irrevocable, meaning they can't be changed. Some trusts are revocable, which we're going to be learning more in a few classes. Revocable means that they can be changed at any point, right? So-called revocable trusts. We talked before, there's other labels, right, that you can associate with trusts. For example, some trusts can be so-called GST trusts, right? Edward, you remember what a GST trust is? Alicia?
Generation skipping trust means...
Generation skipping transfer trust. Generation skipping transfer trust. And taxpayers would set those up so that they can avoid inclusion for estate tax purposes on the demise of their children or grandchildren. Okay, so lots of different labels associated with different trusts. Again, I'm going to ask more about the tax issues than about labels. All right? But sometimes it doesn't even need to say trust. It can be a life estate. And a life estate is going to be taxed in the same manner as a trust. All right? And I said before, don't worry about trying to distinguish a trust or an estate from a business entity in the year 2018 and for the foreseeable future. If someone or people come together to conduct business that is not a trust, okay, that's going to be considered, since it's not incorporated, that's going to be considered a partnership, right? Under the so-called check-in-the-box regulations. So it's a non-issue. And yesteryear, there was concern that a trust could be reclassified as a corporate entity or an association. Not going to be reclassified. If anything, it's going to be taxable as a partnership. All right. Chapter 2. Basic principles of income taxation under subchapter J. And today, if you haven't gotten it, and I'm going to distribute this, we're going to look at some tax returns, okay? And you got it. You guys have these? If you haven't already. Buddy, you have it? Oh, yeah. Oops, all right. So we're going to look at some tax returns today, and you're going to see that when you look at these tax returns, that the basic principles that you guys learned in income tax were with the Form 1040, you can apply in this class. All right? So again, fear not. No one's going to have to complete a tax return, but you're going to see some of the real complicated stuff we've been looking at is not going to be as complicated as you think, okay? For practical purposes, which is hopefully reassuring. All right, so chapter 2, and by the way, just so you can keep it open, not a bad idea. And towards the end of class, so I hope I'll keep everyone here until the end. There's a problem. One of the problems deals with so-called a simple trust, problem 2, which is the one that we'll look at tonight. And see, it's entitled Problem 2, Simple Trust Features, right, in the handout. And if you want to keep that open, obviously we have enough room. Everyone has enough room next to them. Is you can also keep a copy of the tax return open on the, everyone have a Form 1041 now in front of them? Justin, you have that? Almost. Anyone not have it? And it says problem 2, simple trust. Alicia, you're not there yet? Keep flipping. Good. Problem 2. And there it is. Everyone have it now? Oh, there, you got it?
Yes.
Buddy, you got it?
Yeah.
All right, good. So what I want to look at the left. Check in all that apply. Everyone see that? On item A? Decedent's estate. Simple trust. Complex trust. Qualified disability trust. ESBT. Grantor type trust. Pooled income fund. For our purposes, for purposes of this class, we are only looking at decedent's estate, simple trust, complex trust, and grantor type trust. Okay? You see those labels? Okay, you see that? All right. So, and the reason I'm in particular calling this to your attention is under income on the Form 1041. In chapter 2, we begin with the concept of gross income. Everyone agree? And then later in the chapter, we talk about deductions in chapter 2, right? On the Form 1041. Does anything strike you as unusual here under income? Well, you see, there's interest income, dividend income, business income. Last I checked, there's no salary income, right, guys? A trust or an estate doesn't earn W-2 wages, right? It's not like an employee. You know, all the things that you would normally perhaps see on a Form 1040, right? And with respect to deductions, very similar, right? In some respects to a Form 1040. Obviously, in a Form 1040, you're not going to see fiduciary fees, right? And the structure is different. But notice how these items, how the return is structured. So chapter 2 largely covers income and deductions right here on the tax return. And all the complexity that we're looking at in chapter 3, where's that captured on the tax return, guys? Look at Schedule B on the next page. Schedule B is the key to D&I. You see line 7, Schedule B? And then look at line 15 of Schedule B. Everyone see that? That's income distribution deduction, IDD. Simone, you got this? Yes. Right? So that number on line 15 is key. That distinguishes a trust or an estate from a usual taxpayer, because that's going to end up on line 18 under deductions. Everyone see line 18? We're not going to deduct D&I. Depending on circumstances, we may deduct the income distribution deduction, right? It's a modified D&I. sometimes they use those terms and practitioners use those terms interchangeably. IDD, I should say, income distribution deduction, and modified D&I, using those terms interchangeably. So,
Line 18 is modified.
line 18 is modified, yes. All right, modified D&I. So you can see that chapter 3, notwithstanding its complexity, is captured, or largely captured, in Schedule B of the Form 1041. So what I'd like to do tonight, among other things, is continue our reading of the textbook, but then, time permitting, we'll actually go through a very simple return so you can see where it ends up on the return, so that hopefully you'll see that if you put in the time, effort, and energy to look at the more complicated things, that when we actually see the tax return, it's going to be a breeze, all right? Fingers crossed. All right, so that's the goal line. I'm trying to give you a little foreshadowing of where I'd like to see tonight go. All right, and then what we're going to do next class is we're going to not read that many pages. We'll go ahead and maybe page 205 for next class, which is not too many pages from where we are even tonight. And then we'll go through one or two more examples of filling out returns. Again, not with the notion that you're going to actually complete a tax return, okay? You're not going to complete a tax return, but this will be helpful and useful for you, just, I think, putting the material together. All right? So, okay, a little foreshadowing there. All right, so chapter 2, as I'm going through it, the first part talks about gross income, reflected again on the front page of the Form 1041. And beginning on page 30, there's a discussion of generic discussions, the deductions. But the deduction part, not complicated, with the caveat that if the trust or estate produces tax-exempt income, part of the expenses have to be allocated to the tax-exempt income. Okay? Part of the expenses have to be allocated to the tax-exempt income. And we talked before, too, about Taxation 212 and how it applies in this context. We talked about manufacturer's handover and how do you allocate these expenses, and we saw the numerator and denominator, where you had the numerator being the tax-exempt income and the denominator being D&I, right? Denominator being D&I, which often does not include capital gains, right? But there will be some instances where it will include capital gains, right? And we're going to see that even tonight. I keep coming back to, and after tonight, pages 57, 58, 59. We're going to go through several different more examples, and again, this should be hopefully easier for you to distill and digest. We talked about the personal exemption, that trusts that pay out all income currently, get a $300 exemption. Trusts that do not get a $100 exemption. Estates get a $600 exemption. We talked about the 642C deduction with respect to charitable bequests and charitable giving by a trust or an estate. We saw it's different than for individuals. We saw how depletion and depreciation follow the income, right? Wherever the income is distributed, that's where depletion and depletion, how they're allocated. I'm just turning pages, trying to get us up to where we are. We talked about the application of the passive activity loss rules, and we saw how the courts have ruled, at least now on 2 occasions, the Carter decision and Agaron, can't pronounce it, but there's another decision that affirms this decision that says that essentially it's not just the activities of the trustees, but whomever they hire to determine whether or not there's material participation. Beginning chapter 3, which again, those coming in a bit late, is chapter 3 is a reflection of Schedule B, largely a reflection of Schedule B of the Form 1041. So when we go through that, we're going to be looking at Schedule B. David, you already have this handout? Carlo, do you have this? David, can you just pass it up there? Sure. All right. So first thing we know, right, that the receipt of a gift or request is not taxable, Code Section 102. But the income generated on a gift or request is subject to tax, right, because 102B says it is. And an extension of that is with respect to trust and estates. When they make distributions, we have to see what's being distributed, principal or income. There begins the discussion on page 123 of D&I. And like I said, when we go through the tax return, we're about to spend 40, 50 pages looking at D&I, but it comes down to a few entries at the end of the day on a Schedule B of the tax return. And it's not just D&I, right? Again, it's modified D&I. So I know everyone would like to open up a champagne when you figure out the right numerical answer for D&I, but not the time yet to enforce the bottle. You got to find out modified D&I. And D&I, does it or does it not include tax-exempt income? Does D&I include tax-exempt income? Go ahead, Valerie. Does it include tax-exempt income?
D&I?
Does D&I include tax-exempt income? Okay?
No.
Does it? Yes, no, maybe? Say again, Alicia?
We add back tax-exempt income to taxable income.
Well, in computing D&I, does D&I include
Yes.
tax-exempt income? Yes, it includes tax-exempt income. Okay? D&I will include tax-exempt income. Do not forget that. It does include tax-exempt. Does modify D&I or the income distribution deduction, does it include tax-exempt income, EK?
Does it look like it?
I would say no, because it looks like it's reported separately in the 1041.
Yeah, it's subtracted. In other words, if you look at this Schedule B, and for those who are coming in a little bit late, we're looking at problem 2, simple trust. Everyone have problem 2, simple trust in Form 1041? So we point out on Schedule B, we start off with adjusted total income. Look at line 2. We add back tax-exempt income, right? To compute D&I. Everyone agree? But notice line 12. We then subtract out the same number we added. Anyone see that on Schedule B? Shane, what do we add and then subtract it out? Dane, you have any ideas? The exact same number is added, the exact same number is subtracted. Okay?
Well, you add it because it goes to the beneficiary, so that's the income to them, and you subtract it back because it's tax exempt income, so it's not taxable.
It's not gonna, you don't wanna give the taxpayer a deduction.
Right.
On the front
right.
page of the Form 1041 for tax exempt income, okay? That number at the bottom of Schedule B represents a deduction, right? That's gonna end up on the front page of the 1041. You don't wanna give a deduction for income that was never included, right? I'll repeat that. You don't wanna give a deduction for income that was never included. However, when we're trying to figure out the character of the income to its recipient, part of D&I is comprised of tax exempt income, and part of what the recipient's gonna get is tax exempt. Everyone agree? So if the entirety of the income was tax exempt, let's say there was $10,000 of tax exempt income earned by the trust. D&I would be $10,000. Everyone agree? What would be modified D&I, Alicia?
Sorry, I was thinking it was something else.
Edward, what would be modified D&I? I don't know what you mean by that. Give me a number. Jen?
You don't add tax exempt income to modify D&I.
I just said, if the trust earns $10,000 of tax exempt, that's the only income it earns. What is its D&I? 10,000. What is the modified D&I or income distribution deduction? Zero, right? And that makes sense, right? Because if you don't want to carry it to the front page and give the taxpayer a $10,000 deduction. Everyone agree? It was never included in income to begin with. But we need to know for D&I purposes so that when the recipient gets $10,000, oh, they have $10,000 in tax exempt income, right? Because that's what comprised D&I. So, no, it's not a flaw in the return that you see the same number added and subtracted, because someone who's green and has never seen these returns might think, gee, that doesn't make sense. There's a dual purpose on Schedule B. One is to, and we're going to go through the K1s to the recipient. Because remember, we're going to be looking, it's right there. We're going to be looking to the recipient. Code Section 651. Code Section 651 represents what is deductible. Code Section 652 represents what's includable, right? And in this case, guys, there is supposed to be symmetry, right? I'll repeat that. Code Section 651 and 652 deals with simple trusts, right? In simple trusts, the mechanism for deductions is Code Section 651. The code section for inclusion is 652, right? And it's supposed to produce a symmetrical outcome where whatever is deducted by the trust or estate theoretically should be included by the beneficiary, right? Remember, this whole course, or at least this facet of the course, is designed, right? It gets to the issue of assignment of income. In other words, we're not talking really how much is taxable, all right? That's not the real issue. The major thrust of subchapter J is it taxable to the beneficiary? Is it taxable to the entity, meaning the trust or estate? D&I is the gatekeeper to decide who gets taxed on what, right? And this Schedule B on the Form 1041 then is of critical importance. So as you're going through this week and next, I really want you to focus on this concept of D&I and focus on this concept of modified D&I or income distribution deduction. Because those are two different numbers, both are of critical importance, and they will help you get to the promised land of mastering this material. And we're going to go through, and like I said, for those who came in a bit late, notwithstanding the complexity of chapter 3, and at some point you may want to throw your book out the window, into a fireplace, pick whatever method you want. If you can bear and grin it, once you start going through some of the very simple fact patterns, and 98% of trust and estates really reflect some of these simple problems. So yeah, the authors have to make it, stir up the pot here with the 2% of real, I'll call it more complex issues. And you'll also see by going through problem 2, as we gear up towards it and to class, a computer does a lot of the legwork, all right? But computers need your, at least for now, which is the good news, need your assistance. I'm working on I told my income tax class, I'm working on a new op-ed. I haven't finished it yet. I'll share it with you. It may never see the light of day. The title of the new op-ed is called Tax Robots, ? Ask Alexa, ! And if you want to have fun tonight, if any of you have Alexa at home, you may want to ask Alexa, should she do, and I will tell you what the impetus behind this was. Bill Gates said about a year ago that maybe we should tax robots, because by taxing robots we could raise revenue to retrain the labor force. So this piece and a longer piece I've written discusses what that means in practicality. So that's the nature of this op-ed. And if you're interested, just yesterday the New York Times had a coincidence. The front page of the New York Times, anyone see anything about something like this? The front page said that there's a real revolution going on in the hotel industry, because hotels are now trying to shed their receptionists, that you go up to a kiosk just like you do at fast food, and when you check in, you don't need to talk to anyone, and they're trying to shed labor in the form of, call it a robot, call it a kiosk, whatever you want to call it. But you can see we're transitioning away from having humans in a lot of these places. So okay, ask Alexa what she says, and then you can read my piece. All right, so my point though is that we can go through this, your computer software can, but you'll see there's things that, good news, you'll still stay employed because it needs your help, okay? And you need to be in a position where you can tease the computer to get to a better answer possibly than what's going to be produced to you, okay? So that's the good news. All right, so what we saw beginning on page 123 is a discussion of D&I. And I said to you, if you get a chance, I said that the regulations that the authors ask you to read, right? Everyone see the regulations? That the regulations are something that hopefully you look at, because I think there's 12 or 13 examples that I went through. I gave a handout. You'll see in several of those examples, capital gains would be included in D&I. So do go through them. They're so much easier to read than the book itself. So if you want a refresher, just go through the regulations that the authors directed to. Look at the 12 examples. They are not hard to follow. All right, so we went through, I don't want to spend too much time on material we already went through, and we talked, where the authors bring up all these private letter rulings, all these cases, talking about facets of D&I, and we left off, I believe, on page, I'll confirm right now, I believe we left off on page 150, correct? Before I go on, any questions or issues or concerns? And we're going to look at these later. problem 3-2A, 3-2C. Hopefully those, V was kind enough to videotape a week ago Friday's class. Hopefully those who couldn't attend the class were able to watch the video and hopefully absorb this material. And in some form or fashion, we're going to go through it again. These are the problems beginning on page 149. So on page 149, it's going to be useful because some of the new problems dovetail with these problems. All right, I'll summarize the problems in a second. Any other questions or issues? Everyone's good? All right. Then, so 3-1 says calculate D&I of the trusted problem 2-2. So in 3-1, we just took tentative taxable income. We took the personal plus the personal exemption. We added that back, and the net tax exempt income, and this became the D&I. Now, just so you know, and you don't drive yourself nuts, on this actual Schedule B, no one screwed up, because if you look at Schedule B, which is the starting point is adjusted taxable income, you see that?
We're talking problem 2?
Problem 2, Schedule B. And that's taken from line 18. Excuse me. That is taken from, that's taken from line 17. Notice, if you look at page 1 of the return, where it's now going to end up on line 1 of Schedule B, the personal exemption has not been deducted yet. So that's why it's not added back on Schedule B. If you were wondering, like, oh my God, this schedule is flawed because D&I, you see we add it back here, and you'll see that throughout, right? I'm just saying when you get down to practical purposes, on Schedule B, it's not added back because it was never deducted when you take the carryover number from the front page of the 1041. Alicia, you got that?
Yeah, I have a problem because so we have 83 to 80, and what's here on this return?
This is 83 to 80 would start off on line 1 of Schedule B. Okay?
And you use 64, 142?
Well, obviously that's a different number. They're unrelated.
These problems are not related?
Totally unrelated.
Okay.
I never said they were related, Alicia.
Okay.
I just said, I'm just making observations of how the form works. Okay? That's the only observation I'm making. Okay? Now, I'm just calling to your attention as you're reviewing Schedule B and you're wondering, because, right, when did your brain go there? Because you want to compute D&I, and one of the Code Section 643 says add back your personal exemption. Well, you don't need to add it back on Schedule B, because if you look where the number is taken from on the front page of the 1041, it never deducted the exemption, okay? So, just, I just want to try to put some of the pieces of the puzzle tonight together. I kept promising the last 2 classes that we would do some of this so that you could sleep at night. That's part of the objective tonight. All right, so notice to compute D&I, right, we added back the tax, added into a tax exempt income. Then it says, assuming the problem 2-2 also realized $200,000 in capital gain. Okay? Calculate the trust D&I if the trust distributes only fiduciary accounting income. And we said in this case, D&I would stay the same. And no, Alicia, don't look for this number on the actual return. But if you look at Schedule B, okay, on line 3, it says net net gain, right? And if it's a gain, what it would end up happening is you enter that as a negative number on the actual, which makes sense, right? Everyone agree that a capital gain would become negative because you're going to subtract it from D&I. So D&I, go ahead, Clay.
What page are we on? I'm lost.
Do you have a handout, Clay? We're on Schedule B of problem 2, sample problem 2.
It says page 100 on the bottom.
Can you just point it out to him? Okay? My point, Clay, in showing you this is that chapter 3 comes down to a few lines on the tax return. That's why, in part, when I'm working on this new textbook, I'm trying to demystify some of the stuff that you guys are plowing through in our existing textbook. All right? All right, so we're all there. We see that even if it has a lot of capital gains, many times capital gains are just taken and D&I is the same. Everyone agree? Edward, did you see that? Okay, you got it? And then, if it distributes $200,000 of principal, the answer would be the same, right, if it's not distributing out the capital gains. Okay, so problem 2, the problem D would be the same. The answer was the same. 3.2B was the same. And 3.2C is calculated that trust distributes not only fiduciary accounting income, but also $150,000 or $200,000 of principal. And thereafter, there's only $50,000 of principal. So we said that in that case, de facto, $150,000 of the capital gains had to be distributed, right? If you have $200,000 of capital gains and there's only $50,000 left, everyone here can handle that arithmetic, which means that $150,000 of the capital gains had to be distributed. Okay, so it had to comprise D&I. So we had to go back and figure out our tentative taxable income, but now the trustee fee that was deductible is going to be greater than the trustee T fee that was deductible before. The trustee fee is here. It's become bigger. Why? Because the denominator is bigger. Why is the denominator bigger? We have tax-exempt income is the same, right? The numerator is the same. But now the denominator has increased by $150,000, right? Right, Jen? It's increased by $150,000 because now the denominator includes the capital gains, where the denominator, when we computed the disallowance here, did not include capital gain. Remember, we did not, just like manufacturers Hanover case, we did not include in the denominator any capital gain. Here, we had to include the capital gain, and therefore, just for your notes, it was 40 over, the denominator was 290. 290 was the denominator. Because before, the income was 140, and now it is 290. So the loss disallowance is 14% in this problem. Again, the computer, you're going to see when we go through this problem in class, you're going to see the computer does this all for you. let me just finish this and then. So we compute our tentative taxable income, which includes capital gains, right? Includes the capital gains, and now we're going to figure out D&I. And we're going to subtract out the personal, or I should say it the other way. We're going to add back in the personal exemption. We're going to subtract out the portion of the capital gains that remains embedded in the trust. And we're going to include the tax-exempt income, the net tax-exempt income. And our D&I is 273, which is not surprising. We would have anticipated that. Why? 123 was our D&I without the capital gains being distributed. What's 123 plus 150? 273. Because we know that embedded in this number, this 273 number, is 150,000 in capital gains. Alicia.
Okay, so I just want to clarify something. So in problem 2422, it says that this trust is required to distribute all income annually. And in problem 3.2, it says that it has long-term capital gain, 200,000 long-term capital gains.
Right?
Yes. So
But it's not distributing it. In other words, normally a trust that distributes only income would not distribute a capital
Okay.
gains.
But in problem B, it says that this trustee distributes not only fiduciary accounting.
Right, but it has,
but
let's say,
also
$10 million of principal, and it's going to also distribute $200,000 more.
Okay, so it has one.
It has a lot of principal.
Okay.
In problem C, apparently it doesn't, so when it makes its distribution, some of that capital gains is going to be carried out.
So what if it was the first year and this trust wouldn't have any principal?
Then Alicia,
$200,000 would be the only principal.
well, if that's true and it's distributing out a portion of the capital gains, then you answered your own question. It's going to be part of D&I.
It's going to be part of D&I.
Which makes sense, right? Because then you want to have the taxpayer who has the liquidity pay the tax. Normally a trust that has $10 million and has a $200,000 capital gain has liquidity to pay tax, right? Everyone agree? Trust has lots of money, experiences capital gain to pay the tax. In problem C, where there's a $200,000 capital gain and most of the monies are being paid out, right? It may not have the liquidity to pay the tax. So go through the examples under 643 in the regulations, which are fairly straightforward, and you should be in a pretty good position. I hope, fingers crossed. All right, keep thinking about this because I do think maybe I'm being overly optimistic that as the night progresses, this is the night where you pull it all together, Alicia. You'll pull it together, you'll see it will come together.
So I have one last question. So in C, if it says, but that the trustee distributes not only accounting income but also $200,000 of principal to the beneficiaries, and therefore only 50 of principal remains in trust, it means the total was 250.
Why do you say 250?
Because if it distributes 200,000 and it's only 50 left, it means the total principal was 250, yes?
I mean, I'd like to know how much the fiduciary accounting income was. Yeah, I like
Let's
to.
say there was no fiduciary accounting, it was zero.
No, because, Alicia, just hold off your questions, okay? Because we're gonna make up things and I'm gonna get into trouble because you.
Good,
if
so
it had-
give me the break, because I really need to understand.
All right, yeah, I think if you give me more time, you'll get to the promised land.
Okay,
All right,
sorry.
distributions to beneficiaries, okay? distributions to beneficiaries. Just keep in mind, this is the Brigham case, and this is a case where a spouse, if you recall, a spouse can elect to take against a will. If your spouse disinherits you, you can elect to take against the will. What does that mean? So, Jen, you're married, your husband's worth $3 million, sadly he dies, but even sadder, he doesn't leave you anything, okay? You don't have to just walk away from that. You can elect to take against his will and get 1/3 of his estate, right? Everyone get the visual? And in this case, if Jen did make the election, that's what happened here. Normally, when an estate or a trust makes a distribution, right, it carries out with a D&I, right? Under the prior 1954 law, the trustee could decide, oh, I'm distributing income or I'm distributing principal. And Congress didn't like that. There was too much left to discretion where taxpayers could play games where they could target either the trust or estate to retain the income or distribute it to the beneficiary in the lower income tax bracket. So Congress obviously in 1954 shed the tracing system. And essentially, when you make a distribution from a trust or estate, if the trust or estate has D&I, right, it's supposed to carry out the D&I to the beneficiary, right? That's after 1954, distributions are supposed to carry out D&I. But let me ask you a question. If your husband had $3 million, Jen, and you elected to get $1 million, right? The question is, are you really getting a distribution from the estate, or do you consider yourself as if you had gotten an inheritance? And if it's the latter, wouldn't Code Section 102A shelter you so that none of it would be taxable? And by way of contrast, if suppose the estate earned, picture if you will, the estate earned during the administration process $300,000, okay? And Jen gets $1 million, okay? So it has 1 million, well, let me make it even easier. Jen's gonna elect, and she's gonna get $1,100,000. And the estate had $300,000 worth of income during the course of the year, all right? The IRS took the position that, hey, Jen got a distribution of 1.1 million, and the estate had 300,000 of D&I. She should get a K1 with $300,000 because she got the distribution for the year. It could pull out all the D&I. She's the only one who got the distribution. She should be taxable on all $300,000. Everyone understand the logic of the IRS? That it was she was receiving a distribution. She should be taxable on. And for whatever it's worth, the IRS prevails here. The IRS prevails here. Okay? The court agrees with the IRS. And Jen is not really a beneficiary. Excuse me. The taxpayer argues she's not a beneficiary. She should not be taxed. In other words, she elected to take against the will, and she's not a beneficiary as defined in Code Section 662. Who wins? The IRS wins. But if you look at the page 152, in 1997, Congress amended 663 to extend the separate share rule to estates as well as the trust. In 1999, the Treasury promulgated regulations that a surviving spouse's elective share is just that, a separate share. And under the regulations, the outcome would be different. So if you look at the example under Regulation 663C-5, Example 7, essentially this regulation reverses the outcome in this case, and it says the monies that Jen receives are tantamount to a bequest, so she should be sheltered under Code Section 102. Okay?
You said that she would elect to get 1/3. Why only 1/3? Why not all of it? Or
because you can't under state law. State law only allows the surviving spouse the right to get 1/3.
and who gets the rest?
whomever her husband left it to.
Oh, okay.
Oh, this is like New Jersey, right?
Most states have that same law.
So not like California, like a non.
California, I don't know what the law is there.
Are these are those community, wouldn't it all be hers anyway?
Well, community says you're entitled to, like, she has 1/2 of the property. But it doesn't, I don't know what the laws are if you even have an elective share because you already have 1/2. So I don't know what the laws are in community property states. New Jersey's a little bit quirkier than most. Most states you get a flat 1/3. New Jersey's actually different. If Jen, husband had 3 million and she had 1 million, New Jersey actually backs out with what's in your own name. So if Jen had 1 million, she couldn't elect against his will because she has 3 million times 1/3, which is 1 million, less your own 1 million. She gets 0 under the elective share statute. So New Jersey's a little harsher than other states. Most states just say 1/3, plain vanilla.
It's fair, more fair.
It is what
It is what it is.
it is. What it is. All right. So anyway, we have a revisiting of the DuPont state. Okay, remember Mrs. DuPont lived at this very luxurious mansion in Delaware. Again, during the fall, guys, in a few more weeks when the colors start really turning, I know a lot of people go north to see Vermont. If you go a little bit later in the season, you can go to Delaware and check out the DuPont estate. Anyway, if you recall, she tried to get a deduction, or her executors tried to get a deduction under Code Section 212, and it failed, right? And now they're trying to get a deduction and say, look, she was a beneficiary, right? She was the monies that were expended by the trust were really monies that were distributed to her. So when the trust spent $200,000 making improvements and maintaining the lawns and manicuring the premises, yeah, the money wasn't distributed directly to her, but it was as if the money was distributed to her and she paid the groundskeeper, right? Isn't it? What's the difference if the trust paid the groundskeeper or the trust gave the money to her and she paid the groundskeeper, right? And this should be considered a distribution to her. And therefore, she should be taxed and not the trust. Needless to say, it's a little tongue-in-cheek because for sure the tax years were closed with respect to Mrs. DuPont, okay? By the way, this is 4 years later, 1976. The original DuPont case was 1972, if I'm not mistaken. So this is 4 years later, and I'm sure the years were closed for her. And now the issue is, should this be considered a distribution to her? And if you remember, the court obviously is not going to find her the most sympathetic of taxpayers, or the trust the most sympathetic of taxpayers, because if the court rules in her favor, then it's just going to be leakage to the code. So essentially, they said if you recall, there was back in 1925, there was some sort of interesting arrangement, and I'm not sure if I can figure it out. I'm not sure if the court articulated this, where if the house was originally owned by a corporate entity, do you recall that? And as a quid pro quo, if the house was transferred into a trust, apparently there was some sort of contractual arrangement that the trust would maintain the property. Or is that kind of quid pro quo? Well, so if that's the case, and the trust is contractually obligated to maintain the property, then whatever it does in terms of maintenance is really not being distributed to her, it's just honoring a contractual arrangement, right? So that was the first argument, and the court said, okay, that seems to make sense. So that was one leg of the argument, and then just in case that leg didn't work, the court said that this trust was set up in a fashion that Mr. DuPont really wanted to preserve this property for the long term, for his heirs forever. And that Mrs. DuPont was not really a true benefactor of this property. Yes, she got to reside there, but he didn't do this for her real recreational enjoyment. He did it because he wanted to perpetuate his name and keep this property in the family line forever and ever and ever. And that even if she never used the property, he would want the same money expended to maintain the grounds. And there was a case, it's called Plant, that the court relied on and said, you know what, that makes sense, that whatever monies were expended were not really for her benefit. And if you recall, during the years in question, she was more or less, to use the court's phrase, an invalid, right? She had broken her leg and she really couldn't enjoy the property. But were the grounds being maintained? Did she really enjoy the grounds? And the answer was no, right? So it wasn't as if she was truly a beneficiary of these expenditures. So the court rules that these expenditures were not, or should not be considered distributed to her. All right, so the taxpayer here loses. Does this come up often in practice? Come on. Again, when we're doing the sample questions, and we're looking at some of these sample returns, you're gonna know who's a beneficiary, who's not. Last I checked, myself, yourself, do you guys have too many clients of DuPont, ilk who are coming knocking on your door and using your services and getting into some of these more esoteric questions? And the answer is probably not, right? So, again, it offers some interesting elaboration. I don't think you'll have these issues come up too often in your family, in your practice. And the authors in the material that follows, again, for exam purposes, we're not going to get into the minutia. We're going to keep it really simple with the questions I would ask. Let's move on to page 159. All right. Half the battle, right, guys, in life is identifying what kind of tax issue you have. And part of the identification process in this class is what is a simple trust and what is a complex trust. And here again, guys, yes, there's some complexity here, but if you spend, your time is limited. I hope you read the material in the textbook. I think it will serve you well. And you really have to read the regulations. Unlike partnership tax, guys, which has a lot of regulations and they go on and on and on, the regulations here are not overly onerous. All right? They are truly not. So the authors have spelled out, if you want to look at regulation 651A-1, simple trust. Okay, everyone have regulation 651A-1? Section 651 is applicable only to a trust, the governing instruments of which, requires that the trust distribute all of its income currently for the taxable year. So it's going to require all income to be distributed, and does not provide any amounts may be paid, permanently set aside, or used in the taxable year for charity, essentially. And that's the second condition. And third condition, and does not make any distribution other than current income. So we have three conditions that have to be met. And by the way, the word simple does not appear in the Internal Revenue Code, only in the regulations. Everyone see those three conditions? All income, nothing to charity, and no other distributions. A trust to which section 651 applies is referred to in this part as a simple trust, trust subject to 661, or referred to as complex trust. Notice the next sentence. A trust may be a simple trust for 1 year and a complex trust for another year, right? Ming, do you have an example when that might happen? How could it be a simple trust in 1 year and a complex trust in another year? Any ideas? Or David, any ideas? Arlo?
During termination of the trust?
Termination, right, is one time, right? Every trust must at some point be a complex trust because at some point it's going to distribute more than its income. Ming, you were going to say?
Carry over like several years by the capital distribution, the income from capital distribution carry over.
When you say carry over, you mean it's when you accumulate income. If you accumulate income, it's not a simple trust. Everyone agree? If you accumulate income, it's not a simple trust. Or maybe you have a complex trust, right? It says accumulate income until age 21. After age 21, distribute the income. So you can go from complex to simple. Your termination go back to complex. Or you can have simple, and then at age 30, distribute 1/3 of the principal. So it could go from simple to complex. It can go back and forth, right? And back and forth and back and forth. Everyone agree? So don't think on the form 1041 on the left, I showed you on the left-hand side of the first page, where it says simple and complex, where to check off. Don't think that once you check it off, every year it should be the same, right? Okay. 651A-2, income to be required currently. Now, let me ask you a question, John. What kind of income is this? Can you put a word to it if you were talking colloquially to people in my generic water cooler at the office? No, what kind of income? The word income can mean a lot of things to a lot of people. What does it mean to you in this context?
Money generated and received.
Is there a better, Justin, is there a better word you might use here? Yes. Don't say it with a question mark. Fiduciary, accounting income, right? This is not, right, John, taxable income. This is fiduciary accounting income, right? So when the code refers to all the income distributed currently, it's referring to fiduciary accounting income. Where's fiduciary accounting income defined, B?
In the Principal and Income Act?
In the Principal and Income Act, right, at the back of the book, right? So when you look at 651A-2, maybe you want to write, this is up to you, maybe you want to write in big letters, FAI, as in fiduciary accounting income, FAI. (651A-3), distributions of amounts other than income. Okay, this means, if you look at 651A-3A, the trust does not qualify for treatment under 651 for any taxable year in which it actually distributes corpus. Okay? So if it doesn't qualify under 651, what code section then applies? 661 and 662, right? Everyone agree? That either you're under 651 and 652, or you're under 661, 662. Notice 651A-5. Subpart B has no application to an estate. Why? Why does it say? Why did the regulation say subpart B, which if you look at 651 is subpart B of subchapter J? Why? Because the states never, ever say pay out all income annually, right? I've never seen someone's will says, during the administration of the estate, pay all income. It doesn't happen. So as a practical matter, this regulation affirms that all states fall within the scope of Code Section 661, 662, right? Everyone agree? Look at 651B-1, deduction for distributions to beneficiaries. In computing its taxable income, a simple trust is allowed a deduction for the amount of income which is required under the terms of the trust instrument to be distributed currently to beneficiaries. John, what kind of income is that? That's a fiduciary accounting income. Everyone agree? So you're allowed a deduction up to the fiduciary accounting income. Keep reading. If the amount of income required to be distributed currently, which is fiduciary accounting income, exceeds D&I, the deduction allowable to the trust is limited to the amount of D&I. Everyone got it? That D&I is the cap. That's the most you can deduct. You can deduct the lesser of, and this is why, Alicia, I didn't want to address your question before. You get to deduct the lesser of fiduciary accounting income or D&I. Get to deduct the lesser of the two. And we're going to see this critical part in the next sentence, so you may want to circle it in red, the third sentence. So we understand you deduct the lesser of fiduciary accounting income or D&I on Schedule B of the Form 1040, right? 1041, excuse me. Look at this. For modified D&I, for the modified D&I, right? Or the modified income distribution deduction. For purpose of this part, the amount of income required to be distributed currently, or D&I, whichever is lower, does not include items of trust income which are not included in the gross income of the trust. So in other words, whether you use fiduciary accounting income or D&I, whichever one you use, you have to subtract, when you figure out the deduction, right? It's the modified D&I, right? You subtract out from the lesser fiduciary accounting income or D&I, you subtract out the tax-exempt income, right? To figure out the deduction that's going to end up on the front page of the Form 1041. You'll see it. We're going to go through it. If I have your head spinning, that's okay. I'm going to show you a problem, and we're going to go back to this sentence. I just want you to see where it is.
So the step one will be decide which one is lesser.
We have to decide step one, which one is lesser.
And then we're deducting.
And then we're going to, when we figure, that's going to help us figure out what's deductible, or excuse me, the D&I. And then we have to come up with modified D&I, right? So once we figure out the deduction, turn the page. Or at least in my code, we have to get to regulation 652. And 652 deals with inclusion issues. And 652A starts off with the general proposition A beneficiary of a simple trust includes in his gross income for the tax year the amounts of income required to be distributed to him, whether or not distributed. Everyone see that? Plain vanilla. You get taxed as an income beneficiary whether or not it's distributed, even though you're a cash method taxpayer, right? Why? I'll tell you why. Because if I'm a beneficiary and Alicia's the trustee, and she doesn't give it to me, right? She doesn't distribute the income to me, I can sue her, right? Because she's violating her fiduciary duties. So, Alicia and I can't play games here and say, oh, Alicia, you know, this year I have a lot of income. Don't distribute it to me. Wait until next year when I don't. Those games, wink, wink, don't happen. Why? Because I could always get that income, right? Simone.
How does one know, like, the amount that's required to be distributed?
As a practical matter, it may be a little hard, and that's why even if I'm required to, I'm going to say get the income, and Alicia doesn't tell me until, I'm going to say January 30th of year 2, I still have to include it because it takes her a while to figure out what the income is, right? December 31st, she wants to be celebrating New Year's Eve, right? So, but that doesn't matter, Simone. As a practical matter, the return is not due until April 15th, so I still have to include it because by that time she should be able to give me a K-1 and tell me how much income I was entitled to. Okay? Anyone have any interesting place they plan to be on December 31st of this year?
Yeah,
Where are you going to be, Alicia?
I'm going skiing in Alps.
In the Alps.
Yes.
So you plan to be on the Swiss Alps, right? December 31st. Anyone else? Where will you be?
House.
You're going to have your passport, right?
Yes, I have
We
it.
had a little operating difficulties. I didn't outdate. You want to make sure when you have a passport, you cannot leave the country, even if it's valid, if it expires within 6 months. Do not learn. That's a tough lesson to learn when you get to the airport. They will not let you leave the country. Any other interesting places?
What
Yes.
about you?
Jen, I'll tell my story in a sec. Jen?
London.
He'll be in London. And if things fall into place, we'll see if this really happens. I should be in Tokyo. And I had, 2 years ago, I was in Santiago, Chile. That was fun.
That's fucking amazing.
It was crazy on the streets of Santiago, if anyone's ever celebrated in Chile. Okay. And that's way past my bedtime, but you don't do that too often, so. All right. So simple trust doesn't matter. 652A-2, distributions in excess of D&I. What are distributions in excess of D&I?
Return
Principal, capital.
Principal, right? Not taxable, right? That's the whole purpose of D&I, right? Set the cap. Set the cap. What's the character? Well, whatever the character of the D&I is, it's going to be the character to the recipient. 652B-1. And 652B-2, allocation of income, like 7 or 8 lines, there's a for example there. Guys, for exam purposes, I would choose these very simple kind of examples that you can extrapolate. I do not look in the textbook for complicated fact patterns. They don't work for me, they don't work for you, okay? But if you look at this for example, it's easy to follow. You guys should be able to handle that. Everyone see that, for example, 5 or 6 lines down on 652B-2? And we're going to go through several of these tonight. So I'm not just saying look at this and you learn it on your own. We're going to see, I'm going to go through several very similar kind of examples. I'm just pointing it out to you. And what we're going to see in 652B-3, allocation of deductions, we're going to have 2 kinds of deductions, guys. 2 kinds of deductions. We're going to have direct expenses and indirect. I'll repeat. We're going to have 2 kinds of expenses when it comes to trust and estates. Direct and indirect. And whatever direct expenses, for example, if you have a rental property and it incurs expenses, those expenses directly related to the rental property have to be allocated to it. Okay? Rental, whatever expenses are directly related have to be related or should be expended against whatever income that the expense that generated the income. Okay, that's spelled out in 652B-3A, direct expenses. 652B-3B are indirect expenses. And C describes what are indirect expenses. Examples of expenses which are considered not directed, attributable to a specific class of income, are trustee commissions, the rental of the safe deposit boxes, and state income and personal property taxes. Those are indirect expenses. Those can be allocated any way you want. I'll repeat. Indirect expenses can be allocated any way you want with one caveat. They must be allocated proportionally to the tax-exempt income. I'll repeat. That indirect expenses can be allocated any way you want, but when it comes to tax-exempt income, if the tax-exempt income is 20% of the overall income of the trust, 20% of the indirect expenses must be allocated to it. Okay? And if you say, gee, I really don't get where you're coming from, the example that everyone, when I say everyone, I know routinely cite to, if you look at 652C-4, 652C-4, this is the quintessential example. You should, for next week, take 5 minutes. Now, I'm exaggerating, the wrong way. Take 20 minutes, not gonna take 5 minutes. Take 20 minutes, go through this example. It will pay you back in droves, I promise you. And what you will notice, at the last segment of the chapter, it talks about, it has a chart with income for trust accounting purposes, and it has rents, dividends, tax exempt, in total. And what you'll see there is that essentially 25% of the trustees' commissions have to be allocated to the tax exempt income. But aside from that, the trustee commissions, which are indirect expenses, can be allocated all against rent, none against dividends, because dividends are treated tax favorably. But the rental expenses have to be allocated against rental income. Right? It's a direct expense. So you will see, you have liberties with indirect expenses with one major asterisk, the tax exempt income. So your job, guys, over the course of the next few days, take an hour or two, beyond the textbook, read these regulations regarding simple trust. It's far easier than the textbook, truth be told. And in terms of complexity for exam purposes, I will not ask anything any harder than what you see here, perhaps easier. And we're going to go through several examples tonight which just reaffirm these regulations. So I'm not going to just say good luck to you. We're going to go through this and you're going to see how these play out. All right, so let me just, we have a definition of a simple trust, which is 3 conditions. Require all income be distributed, no amounts payable set aside to charity, and third, the trust does not make any distributions other than income distributions. The definition of a complex trust is anything which is not a simple trust. Where does an estate fall? An estate is always taxable as a complex trust.
Can we say one more time, the simple trust?
Simple trust means 3 conditions. All income payable, no charity, and no principal distribution, no other distributions. The income distribution that I referred to that's mandatory refers to, as John will tell us, fiduciary accounting income, not taxable income. And I'll just, if you want evidence of this, just for your notes, Regulation 643B-1. I'll repeat, Regulation 643B-1 says, income, the word income, when not preceded by the words taxable, D&I, undistributed net income, or gross income, means the amount of income of an estate or trust for the taxable year determined under the terms of the governing instrument and applicable local law. Now I know, EK, your head's spinning, but get the site, 643B-1, because all I'm saying is the regulations simply affirm that when you have the word income standing alone with no adjective in front of it, it means fiduciary accounting income. Everyone understand that? If you see the word, I'll make it sexy. If you see the word, the naked word, income, it means fiduciary accounting income. Okay? And there's no distribution of corpus, because again, if there's any distribution of corpus, it is considered a complex trust. So let me give you an example. The trust can provide for discretionary payments of corpus, so long as there's no payments in the year in question, the trust can still be treated as a simple trust. So, if the trustee, let me give you an example of what I mean by that. Suppose I set up a trust for me, okay? I'm gonna put in $1 million into the trust for me. I'm gonna say the terms of the trust that she may get all the income, but EK is the trustee, okay? I set up the trust, put in $1 million, name EK as the trustee. The trust is for Ming. I say Ming should get all the income, but EK, if you feel it's necessary, give her principal for her health, education, maintenance, and support. That's a so-called HEM standard, health, education, maintenance, and support. And for many years, EK makes no distributions to me, okay? Because she doesn't think she needs any extra money. So she just pays her the income. Is it a simple trust? Absolutely. But in year 3, EK decides, you know what? She needs some help. She needs a bigger house or something. She distributes $100,000 to her in accordance with the standard. Guess what? That's now going to be a complex trust.
And quick question. Those are just little things that happen during the year that will determine if it's simple or complex. It's not like the trustee is, planning ahead. It's just like
No, EK is not planning ahead, and let's face it, on the face of the 1041, she's dictated by her fiduciary responsibilities. The tax return will just be what the tax return will be. She's not going to make her decision based on checking off the box, complex or simple, on the face of the 1041. I'm being really practical here, right, Carla? She's dictated by her fiduciary duties. Okay? Pointing out that there is no difference whether the income is actually distributed. The issue is whether it's required to be distributed. And therefore, no matter what happens, the trust gets a deduction in which it's required to be paid out, and the beneficiary has to include it whether or not it's paid out. And we have a case in our textbook, kind of an interesting case, page 159, right? And here, apparently, and I'm going to just go through some of this because I know I want to get through some problems. Is the father set up a trust for the son. Son was to get all the income, and apparently the son and the father didn't get along, and the son didn't want the income, quote unquote. And remember, at the time, who's taxed at a higher rate in general? Trust or individual taxpayers? Who's trust at a higher tax rate? I'm sorry, generally the taxpayer, right? Now it's the exact opposite, right? Because Code Section 1E, most income generated by trust is at the highest rate. Individuals, you have to earn a lot before you're at the highest rate. So you could see potentially, if you want to be cynical, the son sort of said, well, I don't want the money, so I shouldn't be taxed on it. But if you want to think cynically, maybe he wanted the trust to be taxed on it, right? At the lower tax rates. And at some point, have the trustee make a distribution to him, right? Everyone get the visual? Because the trust was, trust prior to 1986 was used as a sort of a tax haven, right? Because they were their own taxpayers, had their own pretty large bracket structure, all right? Does that work? Does the court say, you know, you didn't want the money, you don't need to be taxed on it? And the court says, no, come on. You had a right to the income. You could have demanded the income. And I think the son was really playing games here because if you don't want something, you can file what's called a disclaimer and essentially say you don't want it and you have no legal rights to it. The son never filed a disclaimer. So I call me cynical. I think the son was playing games here for tax purposes. But it does not work because the terms of the trust gave him a right to the income. Okay? As such, it should be taxable to him. And it was. It was held to be taxable to him. The state of Milford, or Mildred Brunchman. This is a tough case, if you guys read the case. It's not a hard case to read, but it is not, how do I say, it is a case where you read the case and you're like, wow, this is tough judicial system.
Yeah,
Say again, Emmerich?
We had 1,000 families involved there.
There's a lot going on there. Alicia, what was going on here?
I think the daughter was disabled,
Yeah, I think she mentally was challenged.
and then,
And she was an adopted daughter.
yeah.
Picture a husband and wife, adopted daughter, has her own mental challenges, and an uncle sets up a trust. And the uncle sets up a trust and he says, look, I want it to go to my nieces and nephews, and on their demise, it will go to their spouses if married. And then upon their demise, it will go, the income will go to the issue of any other issue. But then when all those people die, then it goes to, there was a term of art,
Lawful issue of body.
to, right, the lawful issue of the bodies of the nieces and nephews.
Whatever it means.
Okay? So there's and I don't know if it was intentional or not. So in one place the trust document uses the word issue, and another place it refers to the issue of the body, okay? And what ends up happening is Mildred is a beneficiary, where she's supposed to get theoretically she may or may not get the income, because it's not clear she's even issued, right? She's an adopted child, right? And during the years in question, she doesn't get the income. She literally does not get the income. And it's only many years later, in fact, I think if I do it, I think she dies in 1949 and this issue is resolved in 1952, if I recall correctly. The point is, this takes several years of adjudication before it's decided. And the court decides that she did have a right. She was issued. Okay? She met the definition of being issued. The word issue means offspring. But when all the nieces and nephews finally did die, was not an issue of the body. Meaning, at that point, she would not be entitled to any principal. Okay? Having said that, who gets taxable on the income? And surprisingly, the court rules, and this is tough, because remember, it's not entirely clear she had a right to the income. It's only in retrospect it was deemed that she had a right to the income, right? During the years in question, she was unclear whether or not she was going to see a dime. Nevertheless, the court ruled that she should be taxable for those years in question. So it's a little bit unsettling, this ruling. Will this come up in your practice every day? No. It makes for interesting reading. And that's why when we go through for exam purposes, we're going to keep it, when we go through after the break, the simple problems, and you look at the simple tax returns. Again, for those who came in a bit late, I am not going to ask anyone to complete a tax return. The only reason we're going through several of the tax returns tonight and in class next week is that you're going to see that this stuff is very manageable from a practical point of view. So bear with going through these cases because, again, you get a gist of what's going on here that in this, again, in this case, remember what the regulation says. You get taxed, if you are a current income beneficiary, you get taxed on the income whether or not it's distributed. So if you read this dissenting opinion here, it is a very well written dissenting opinion. And it makes a number of very good points. So if this issue really did ever come up in your practice, which maybe once in a lifetime it might come up, I think, once in a while a dissent is written that's so compelling that you might say, look, you have a risk here, but you might consider not including it or including it and then filing immediately for a refund and trying to adjudicate this before too many years pass. So I'm just calling to your attention that this issue, this case is out there and it's a tough case for taxpayers and it doesn't make any true logical sense. Any questions about this case? Anything that you guys want to bring to my attention or call to my attention? Okay, so let's just talk some more because, and then we'll take a break as soon as we get to the problems, and then we'll do the problems as soon as we get, as soon as we're done here because I think that there's free pizza right now, and the line is very long. So if we stay here a few more minutes, the line will hopefully go down, and I think they have lots of pizza. So let's hang out here, and then hopefully, again, the line will be down by the time we get out. All right. So there's some revenue rulings you guys can look at. The important point that I want to really call to your attention is beginning on page 172. Why do I want to call this to your attention? Code section 644 came into effect in the 1986 Tax Act. What does code section 644 say? Essentially, all trusts must be on a calendar year taxpayer. All trusts must be calendar year taxpayers. And that's simplified existence because many people used to set up trusts to end on a fiscal year ending at the end of January. Why did they do that? To try to achieve tax deferral, right? But that's no longer permitted. Code section 644 requires that all trusts be on a calendar year. Here's one asterisk, one exception. Code section 645. Well, let me make one other statement. Estates can be on a fiscal year. I'll repeat. Estates can be on a fiscal year. And depending on circumstances, sometimes people set up estates to try to achieve some deferral. So trusts must be calendar year. Estates can be a fiscal year. But keep in mind that people who live in both California and Florida, Those are two big states where many, many people use revocable trust to avoid probate, because probate is an expensive process in both California and Florida. And when someone dies, the revocable trust becomes irrevocable, right? And Congress, to be fair to those people who reside in California, Florida, and there's maybe some other states I'm not familiar with. New Jersey is not among them. But said, gee, if you have a revocable trust that becomes irrevocable, you can make what's called a 645 election. And a 645 election permits you to treat that revocable trust as if it's an estate for 2 years. So I'll repeat, that if taxpayers set up a revocable trust and perishes, for the next 2 years, that trust can be treated like an estate, and it's entitled to not only a fiscal year, but a $600 exemption. All right? Why, again, did Congress do this? To put on equal footing trusts and estates. Those places where estates are, where people routinely use revocable trust.
So it's, you don't see it a lot in New Jersey?
New Jersey, I'm a biased person. Generally, I stay away from using revocable trust for my clients unless there's extenuating circumstances that they need it. Because sadly, Alicia, I think you said unfortunately you lost your husband, your ex, is that probate's very easy in New Jersey. Generally, not always, but 99% of the time, you just go to the surrogate court with a death certificate, the original last will and testament at $100, and you'll be issued letters testamentary. And they've gotten so good, many times that same day, they'll issue you the letters that give you authority.
Will you make an election on the tax return?
Yeah.
Where?
I don't know where it goes on the return. I'm not sure. I don't know if there's a quick answer. On page 173, the top paragraph talks about a 645 election.
So technically, you have this revocable trust, person died on April 1st, and then it's going to be close of the year of this trust, and then you elect 645 from April 2nd, and then you can have a
Fiscal year.
until April.
Yeah. Till March. Okay? So the authors go through, don't worry, like on page 173, there's a discussion about loss of citizenship. You're not going to see anything remotely resembling, some of the minutia that the authors bring up. Again, there's some revenue ruling 74-257. Pretty straightforward. You can look through it yourself. What I'm going to propose, though, in the interest of time, is let me just look at the first three. Let's just go through 3-3 to 3-6, and then we'll take a break, because this is just yes or no. And then when we get into the problems on 3-7, we'll slow down. Look at 3-3 on page 176. A trust is required to distribute all of its income currently to the grantor's brother, nevertheless fails to distribute anything. Okay? No amounts are payable to charity. Is the trust taxable under subpart B as a simple trust? Young Hung, yes or no? And Cletty, see if you agree.
Yes.
Answer yes. Cletty, yes? Yes. The answer is yes. 3-4. A trust that is required to distribute all of its income currently to the grantor's brother is also authorized to distribute principal to him. No amounts are payable to charity. Okay? It's also authorized to distribute. No amounts are payable to charity. Is the trust taxable as a simple trust in the year which no principal is distributed? David, Carlo.
I say complex.
Say complex. Carlo, disagree or agree?
Agree.
You say vague final word?
I think that the trustee can choose to, if no principal is distributed in that year, they can choose to file a simple trust.
Is it simple or complex?
Simple.
Simple, guys. It meets all three conditions. The answer is simple. 3-5, the trust is required to distribute all of its income currently to one or more all of its income currently to one or more, or one of three named individuals. No amounts are payable to charity. So it can distribute to one of three people, but it's required. Edward, Alicia, simple or complex?
I would say simple.
And who's right, Jen?
I'll say simple,
It would be simple.
because it says it's just required, like.
It's required. All the income must be paid out. All three conditions are met. Doesn't matter of whom it's paid. 3-6. Trust is required to distribute all of its income currently to the grantor's brother for life. The remainder is payable to charity. Is the trust taxable as a simple trust in year in which the trust realizes a gain that is eligible under state law instrument to charity? And in this case, EK and Karen, what do you say? Simple or complex? Complex? Karen, agree, disagree?
Agree.
John?
I agree.
Why? Why do you say it's complex?
Because in that year, it said they did distribute to charity.
It says the remainder is payable. It didn't say that year it was payable to charity, right? It realized the gain that is eligible under state law governing instrument to charity. In a year in which it realizes a gain, it doesn't say the gain is income. The gain is
It says that it's
typically
allocable. It's
eligible to
allocable.
corpus, right guys? Capital gain.
Oh, I wasn't reading it that way.
If you look at regulation 651A-4, I'll repeat, 651A-4, this should qualify as a simple trust. Now, guys, unfortunately, we don't have the luxury of time tonight, so we're going to try to get, if there's food, I'll leave it up to you. I don't know what's out there, what's not. We're going to try to keep it relatively short, so try to voyage back here in the next 8 minutes, if that's okay. And hopefully there's not going to be a long line, so grab some food if it's available, and I'll see you everyone back in about 8 minutes.